About a month ago, the government of Kenya, the Treasury rather, released a draft national tax policy, which is available on Treasury's website, and we'll provide a link here for you, and asked for citizens and interest groups to look at it and to send comments on the document, on the draft, by the 5th of this month, which is tomorrow. So at the Institute of Economic Affairs, we have a number of programs or thematic areas of research. Our team at the Public Finance and Management have reviewed the document, and they have some comments based on the memorandum that will be sent to Treasury by tomorrow as required. So that's the background. So that's the reason, that's the discussion we'll be having today. And on behalf of the IEA, I'm thankful that you're here. The Institute of Economic Affairs is a think tank, and our work is to carry out research and use that research to inform public education through meetings such as this, but also to provide us with some content for discussions with the public sector, various arms of the public sector, with the view to improving policy outcomes, but also to expand the menu of choices available to government in terms of policies to be taken. So we have a public education role, we have a public sector strengthening role, but we also have the role of educating our members, and at the same time expanding the basket of policy choices for which government should choose. So we are thankful that you're here, and without further ado, I think I'll ask my colleague John to present. But before you do that, let me just go through a few rules. One, please keep all your cameras and microphones switched off while the presentation is going on, so we can have only the picture and the voice of the presenter on here. We have on the floating menu at the top of this facility an opportunity for a chat box through which you can send questions. Of course, there's a Q&A as well. You can send in any one of those, and I will try and read them out after the presentation so that you can have responses to them. And then also we have a reaction box, which allows you to obviously, whether in real time or to ask questions at the end of it. So my colleague John will have about half an hour CPP in which he'll present highlights and comments on the draft national tax policy. Then soon after that, we'll open up for another half an hour or so for comments from you before we close today. So on behalf of the IEA, I thank you again and I welcome John. John, please go ahead.
Yeah, thank you, Kwame. Yeah, my name is John Mutua, and I work in the Public Finance Management program. And together with my colleagues, we put together some comments based on our analysis of the draft national policy, which is what I'll take you through this morning. Now, as Kwame mentioned, the draft national policy is actually, it's a 35-page report structured in 5 chapters. So we have the introduction, chapter 1. Chapter 2 is the situational analysis, which is followed by policy guidelines. Chapter 3, chapter 4 is implementation framework, and the last chapter is on monitoring and evaluation. And of course, it has an annex with some key indicators and stats. So I'll take you through this, mainly not necessarily through all the chapters, but the idea will be to mention some of the comments that we have and comments that we'll be presenting tomorrow to the National Treasury. Yeah. Now, whenever 1 year of a policy, any tax, I mean any policy that the government has prepared, often the question would be what mischief the policy seeks to address. Now, if I had that opportunity to just ask around, what are the many things or issues that are raised by people, whether it's individuals, business people, professional groups, etc., issues related to tax. I'm sure each one of you, the enumerators, as many issues as possible. Now, what this draft national tax policy has done is basically to share some of the challenges of Kenya's tax system. And so I'll present this as they have been presented in the draft policy. And of course, if you think there is any critical challenge that has been left out or important challenge that has been left out, you can always drop that in the chat box. But I'll quickly go through this. So the first one is, and this is probably something, I mean, this is something that we know that, of course, in our country, there is the existence of hard to tax sectors. So what I present there based on statistics from the National Bureau of Statistics, we have data of the formal and informal sector. So Kenya has a duality in terms of the way it is structured. And as you can see there, the informal sector, the share of the informal sector vis-a-vis the formal sector is over 80%. So if you look at the period 2017 to 2021, the informal sector share specifically is 82.2%, and it went up marginally to 83%. And in 2021, it's about 83.2%. So that's the kind of structure that we have as an economy. And it's a sector that has made it difficult for the government to be able to generate taxes for many reasons. Obviously, the informal sector is largely cash based. There's a challenge of record keeping and even tracking the number of, I mean, we lack a database of the actual number of businesses that exist. Those could be there at the county level, but I think at the national level, we still have a challenge of that. So there are obviously huge challenges with regards to to our structure, duality of the economy. And then secondly, we know, of course, the agricultural sector contributes almost 30%, 25 to 30% of the economy, and it's another hard to tax sector for, again, similar reasons to the informal sector, and it's partly actually within the informal sector. So this is the first challenge that is presented in the draft national policy. Then the other challenges, which I will just quickly run through, there are issues related to tax incentives. So one of the key objectives of granting tax incentives is to promote investments. But we have challenges with this. The main one being that there is revenue that is forgone. So there are different tax incentives, tax holidays, tax credits, and so on and so forth. But the revenue that we lose by granting these tax incentives is often not commensurate to attracting the businesses that we expect or investment that we expect to attract. And we'll be speaking into this as we go along. And then obviously, so with tax incentive, the question is the justification basically for granting tax incentives and whether it's based on a cost benefit analysis to be able to go forward with this. Then there are obviously issues to do with law tax compliance. The current data that from the policy, it mentions that filing of tax return by 2021 was 68%, whereas payment of tax is about 88%. So those are the two indicators of tax compliance. Then there are issues to do with, again, related to the hard to tax sectors. We have these emerging new sectors, obviously complexity in taxing the digital economy. Then with regard to the VAT, again, actually the foregone revenues, majority of that, the bulk of that comes from VAT exemptions. and it constitutes about 2.2% of GDP. That is by 2020. And then, of course, with VAT, there are issues related to the multiple rates. So we have the standard rate of 16%, but the other multiple rates, 12%, I think, for catering and hotel levy. And then, of course, we have exemptions and zero rating. So obviously, all this multiplicity of VAT rates creates a lot of ambiguity and difficulties in actually administration of and management of tax collection. Then we have issues related to custom administration. This is in relation to trade taxes. We have actual challenges in regard to tax administration. Then there are issues to do with dispute resolution. So for instance, when it comes to refund of tax refunds. And then finally, there are issues to do with international taxation and tax treaties for the enterprises. Issues to do with the transfer of pricing and profits. So these are the key challenges that have been enumerated in the tax policy report. So as I had mentioned, if you think there's any other critical challenge, please feel free to post it on the chat box. Now, this draft national tax policy is similar to many others. So we basically try to look at various other policies, and we can see that in terms of the structure of the tax system, it covers all the bases basically. So we have the tax administration at the top, the need obviously for any tax system to have a legal and regulatory framework at the base, and obviously the building blocks. These are the different tax structures. I mean, the different different types of taxes, both in direct and indirect. And then, of course, the policy report speaks about the implementation frameworks, the different players, stakeholders within the system, the tax system, as well as it also has a section on the monitoring and evaluation. So from a structure perspective, at least one can see that it has covered all the bases with regard to the design of any tax system. So the goal of the tax policy is to have an efficient and fair tax system that promotes equity in tax administration and predictable tax environment for businesses to operate. And so the objective, like general objective, is basically to expand the tax base so as to enhance fairness and equity in the tax system. Now, the policy also lists a couple of rationale, and these are things that are related to the main objective or the goal of the policy. So the first one is to grow tax revenue. So there are obviously ongoing efforts towards enhancing domestic resource mobilization. So that's like a very clear rationale. Then the second one is related to providing a legal framework for introducing tax incentives. So the coherence in is another rationale for this policy. Then the third one is to provide guidance and ensure sustainability, certainty, and establish. So this is just basically about the amendment to national tax laws. What has been happening is that our tax codes are revised. We have proposals to revise this every year, and so the rationale of this policy is just to provide some certainty in terms of instead of having these annual amendments, the idea is to have this done periodically every 5 years. And the other rationale is to enhance structures for information gathering and sharing. So we have a devolved system of government. So the idea is to enhance coordination and sharing of information, gathering of information, as well as sharing of information within the national level, but also between the two levels of government. Then there is obviously the question of tax refund. I think that's a critical challenge that has been flagged by businesses, manufacturers, etc. So how to manage this efficiently is one of those rationales for this policy. We know obviously the importance of tax refunds in terms of for businesses, in terms of their, providing for liquidity or working capital. So when that is delayed, the turnaround for payment of refunds, that obviously affects business operations. And then the final one is to address complexities in tax legislations and administration. So the idea of simplifying our tax codes. Now, again, somewhat related to the objectives and the rationale are the guiding principles. Again, these are things you can knock them off against the common canons of taxations. So the policy enumerates about 8 of them. There is the equity and fairness, and for equity there is talk about horizontal and vertical equity. So I'll not necessarily go into the details, but the idea is for people who have a similar income, they should pay, the expectation is that they'll pay the same amount of tax, whereas for equity, the tax should go up based on one's ability to, one's income ability, yeah. So that's the equity fairness principle. Then there's the principle of flexibility. Obviously, a tax system should be flexible. There is a question of neutrality. It should distort, minimizing the extent to which whether it's our tax laws or our tax code distorts the economy or the tax behavior. Then the aspect of sustainability, or if you like, adequacy in terms of raising revenues, that this should not affect the economy. The transparency and accountability is obviously self-explanatory. Then there are questions of administrative efficiency, that whatever is collected, the cost of collection of tax should be less than should not be more than what is expected to be collected. There is this issue of simplicity, and then economic growth and efficiency. So those are the guiding principles. And then obviously for the exact definitions, you can get them from the policy itself. So now I'll move on to some of the comments that we have based on our review and analysis of the policy. And these comments, we have comments for each of the sections of the policy. So starting with the introduction section. So the introduction section covers the objectives, the rationale, and the guiding principle. However, there is no mention explicitly in terms of the design of a Kenya tax system. If you review a couple of reports, government reports, VAT used to be touted as the tax of the future. So it is not very clear which way the government seeks to go. In terms of, do we continue to rely on direct taxes, that is taxation on income, or are there efforts towards shifting this to indirect tax? So we know currently that obviously what is collected actually, a bigger portion comes from direct tax. So that has been the most successful source of revenue. But there obviously the fact that we have a constraint, 20% of the economy is formal, and pay as you earn contributes, I think it's the next page, you can see that pay as you earn as a share of the total tax revenue has been going up from 24 to 40% from 2010, 2011 to 2020, 2021. Whereas VAT has both domestic and imports are somewhat connected. So obviously we are seeing there's a burden of a reliance of the formal sector. So it's not clear in this policy the direction in the design of this of Kenya's tax system, whether it wants to continue to go or with the of income. So this is important because it helps in terms of that to put in terms of realizing the goals that have been set in by the policy. So that's the first comment that we make. And then this obviously has to be referenced or pivoted against the principles of equity and efficiency. So that design of a tax policy in terms of the optimal tax mix between direct versus indirect has to always be knocked against the principles of equity and efficiency in terms of whether these taxes will enhance or diminish taxpayers' welfare. Of course, when that happens, there could be other measures that could be put in place to compensate, especially where the vulnerable groups are burdened. Then the second comment, sorry, I forgot to switch on my camera. Okay. Yes. Okay, sorry, I've been advised to switch off my camera, so that's fine. The second comment is in relation to the fact that there is no mention of intergovernmental fiscal transfer system. Whether it's at the introduction or maybe in the situational analysis in the second chapter. This again is important, given that there are implications in the way the tax system is designed. These are implications on the functionality of intergovernmental fiscal system. So whatever revenues are generated at the national level, those are shared between the two levels of government. And so basically what happens with that design has an effect on both, on the two levels of government. And I think it's important in terms of a preamble, it's important that this issue of intergovernmental fiscal transfer is mentioned in the policy. And we also know, obviously, there are, because of the challenges of the design and all, we still have some issues that have been raised around double taxation at the county level. So this issue should either be mentioned at the introduction or even in the situational analysis, because whatever challenges we are facing as a country, those are important in terms of helping with the design of the tax system. So I'll move on to the second chapter. Basically looks at the legal regulatory framework, the legal basis for the different tax heads, income tax, VAT, excise duty, and the trade taxes. Of course, there is also the Tax Procedures Act. Then there's a section that looks at tax administration, the different players, KRA, National Treasury, there are different roles, and then of course the other players. And then there are key issues that have been raised with regard to tax administration. There are issues related to registration of taxable persons, tax compliance, staffing, and so on and so forth, dispute resolution and the like. Now, our comments are specifically with regard to a few issues that have been mentioned, particularly on revenue performance. Now, understanding revenue performance, that history, if you look at the history of how we've been performing, I mean, the economy has been performing in terms of generation of revenue is important in the design of a tax system. Now, the policy gives different indicators and shows performance of revenue. Of course, in terms of growth of revenue vis-a-vis the economy, growth of the ordinary revenue, that is the overall revenue, as well as the different tax heads. So that is clearly presented in the policy, as well as growth in ordinary revenue in relation to nominal GDP. That has actually been going down from 18% in 2010-2011 to about 13.8% in 2020-2021. So that raises the question around the fact that revenue growth is not responding to economic growth. So that's an aspect of tax buoyancy. Now, the comment that we have is that there's a section that has some details on revenue performance, looking at a comparison between actual revenue collection from 2011, 2012, all the way to 2020, 2021. So the blue line, the red line is the actual collection of revenue, whereas the blue line shows the target. So this is basically a comparison between actual revenue collection vis-a-vis the targeted revenue, annual. And you can see the gap has been widening. Save for 2020, 2021, where there was almost some convergence. Now, the report doesn't explicitly discuss of integrity or accuracy in revenue projection. So this is not brought out clearly. At the Institute of Economic Affairs, we have this study that we launched in April, and what the study shows is that revenue forecasting, we have errors in actually revenue forecasting. So if you look at this graph from 2014-15 all the way to 2019, these errors have actually been going up. And these are projections that are done 9 months before the start of the financial year and about 4 months before the start of the financial year. So for the 9 months, it's the light green BROP, whereas this is actually revenue collection. Revenue forecasting actually. And basically what you can see, there are errors, and these errors have been widening. And this obviously has implications. Now, from our own analysis, what we've seen is that the issue of revenue forecasting is not necessarily a question of capacity or it's not a technical question, because we've seen that the National Treasury has now, initially, whereas there were challenges with the models that are used and the assumptions that are factored, and even just that capacity, staffing and so on, that has increasingly improved. So a question of capacity, but more a political economy question. And these errors are actually driven, or the incentive of these errors is obviously to understate the size of the deficit, to show it, so just to make it look like it is smaller than it is in the actual sense. So that issue of integrity of revenue forecasting has not been mentioned, and yet is actually an important issue when it comes to the functionality of intergovernmental system. This obviously affects leads to delays in disbursement of funds to national government, but county governments are actually and if you look at the split between expenditure and development, recurrent expenditure and development expenditure, what suffers most is development expenditure. So obviously what that means is that in the medium to long term, the expected development outcomes or outcomes actually would be affected. So it's important that this issue is explicitly mentioned as a challenge in the policy. And then the second one is the need to ensure that there are regular reports on revenue forecasting. These are useful in terms of enhancing meaningful public participation. Then moving on, so that's the main comment that we have around that issue is not well presented or comprehensively presented. Of course, there could be other issues in relation to tax buoyancy, and stuff related to tax buoyancy, I think, calls for some studies, further research in terms of what can be done. I mean, just basically to understand why revenue growth is not responding to economic growth. Then the final section or part of our analysis is we have a couple of comments on the policy guidelines. So this is chapter 3 of the policy. And so chapter 3 basically is a review of all analysis. And this chapter gives commitments or guidelines on the different challenges of our tax system. And so it enumerates what the government will do in relation to all those challenges that we have taken you through. Now, looking at the first guideline on predictable tax rates and tax base, so obviously the Constitution provides, we have a FIS and the Public Finance Management Act 2012. One of the fiscal responsibility principles is to have a predictable tax rates and tax bases. Obviously, this is key for businesses, for certainty, for planning and all. And there are reasonable, there are guidelines that have been provided that will lead to reasonable degree of predictability of tax base and tax rates. And so the policy provides a commitment that it will undertake comprehensive review of tax laws every 5 years to align with other government policies. So obviously this is important in terms of actually reducing that multiplicity of tax rates. So that's a good one and it's commendable. And secondly, the second guideline notes that that the government will undertake stakeholder engagement before undertaking any amendment of the tax law, and that the analysis will consider the impact of the proposed changes on tax revenue, development, investment, employment, and economic growth. However, as much as looking at different national tax policies, the issue of gender equity is not mentioned explicitly. We feel that, or our comment is that this guideline does not capture welfare indicators and the impact of different social groups that will arise given government revenue raising measures and expenditure. The fact that these revenue raising measures and expenditure, what is called fiscal incidence analysis, will affect groups differently. So if you have the population and you split it by whatever groups, whether it's 5 groups looking at the richest, the moderate, and the poorest, any tax raising measure will have a different impact on these different groups. So it is important to include the welfare indicators in this. So that is actually, that statement is quite neutral and doesn't factor that, whereas this is a critical thing that should be noted. So we also note that there is the policy states that the National Treasury will submit annual reports to the Cabinet on the implementation of this policy, but there is need to capture implicit biases that arise during implementation to ensure principles of equity and fairness are upheld. So again, that speaks to the issue that we've just raised. So for these principles to be upheld, there is need to, at all times, just ensure that whatever analysis is conducted and reports, those reports clearly specify the effect of revenue raising measures, or provide welfare indicators that will mention what the impact of revenue raising measures will be to the different social groups. So that's something that is missing, and it's important that it is captured as well as reflected in subsequent reports. Then policy guideline 3.2 is related to the add to tax sectors, specifically agriculture and informal sectors. Now, this is something that has been a major challenge for the government, and there have been various reforms and interventions around trying to broaden the tax base or trying to bring in on board the informal sector into the tax net. And we've spoken about the over-reliance of the formal sector. So the objective here is to progressively increase tax yields from these add to tax sectors. Now, some of the things that have been tried in the past, we have had the turnover tax. TOT is turnover tax. And this turnover tax was based on businesses, small businesses, medium enterprises. This was actually launched established in 2007. And it was businesses that had a turnover of between 500,000 to 5 million were taxed at 3%. However, this turnover tax was not successful. It didn't achieve much, basically. And so this was actually replaced in 2019, I think. I'll need to check the year. It was replaced by a presumptive tax. And so presumptive tax is actually 15% of the amount payable for business permit or trade license issued by a county government. So what the government, together working with KRA, has been trying to do is basically educating small businesses on the importance of paying this. Obviously, these businesses should, for equity purposes, pay their taxes or their dues, but capturing them has been a challenge. And we've mentioned some of the challenges with regard to the informal sector, record keeping. Most of these sectors are cash-based and so on and so forth. So whereas this looks like, I think also involved by some evidence and studies, maybe a good move, but it may also face some challenges. So there are questions about maybe underreporting of receipts by businesses, or reversion of payment of business permits, because this is only captured when a business goes to renew their permits at the county government level. There could be also some other behavior in terms of underreporting of receipts by formal businesses, so as to move from paying corporate tax at 30% to paying this cheaper presumptive tax. So those are some behaviors that may manifest in this. But currently, of course, there's been a lot of efforts in terms of tax education around this. For agriculture, I think their plan is to work with the SACCOs in terms of identifying farmers and so on and so forth. But these are some of the challenges that they may face, and these have not been clearly articulated in the policy. Then with regard to tax incentives, The basis for granting tax incentives is obviously to promote investment, and the second one, which I had not mentioned, is to relieve vulnerable groups. So VAT exemptions and zero rating are obviously targeted towards making essential goods affordable, especially for the poor. And we know that VAT is a regressive tax, as in the burden of this tax is felt more by the poor relative to the rich, and hence the reason for those different incentives around VAT. Now, the draft national tax policy provides a correct diagnosis of the challenge with regard to tax incentives. One, there are issues of coherence of the law. There are moments where waivers would be granted without, not backed by any law. So there was a bit of abuse of tax waivers and so on. There are obviously questions around justification for tax incentives, etc. But what has happened is that tax incentives also erode the tax base. So the revenue that we are losing, or the foregone revenue, as much as it has decreased from 5.2% of GDP to about 3% between 2017 and 2020, as much as that has reduced, it is quite significant if you look at it against that promotion of businesses. Of course, studies show that there are other things that businesses look that are of priority to businesses, things like political stability, infrastructure, cost of production, and so on. And tax incentive tends to come lower in that priority list, and hence some of the challenges that this has had in terms of promoting investment. So what we note here is that there should be comprehensive reports on tax expenditure analysis and estimate, and this should be part and parcel of budget policy statements and budget estimates. So the transparency around tax expenditure accruing from this tax incentive, the different tax incentives, is absent. And so in order for the public to be able to scrutinize and interrogate there's need for these reports to be made public. Then 3.4 guideline is about increasing tax compliance. So the draft national tax policy focus is to progressively increase tax compliance by enhancing public tax education and awareness and administrative reforms. There are two things or 2 points that we've noted here. That yes, taxpayers' education is quite important. Whether you look at it from the aspect of educating people about this presumptive tax and just overall tax compliance. But what is missing is, and I think the fact that there's need for some specific program with dedicated resources to ensure that we have continuous taxpayer education, engagement, and awareness. Otherwise, without that, that will fall into cracks. I mean, we'll have a challenge in terms of ensuring that we have continuous taxpayer engagement. Then the second one, now, when it comes to tax compliance, studies and evidence shows that there's a positive correlation between improved service delivery and rise in tax compliance levels. Now, what we've noted in this policy is that commitment on the public expenditure management side. We know, obviously, issues that have been raised by the Auditor General's reports around proper use of resources, lawfulness, and effective use of the resources. And the Office of the Controller of Budget has also flagged various challenges when it comes to budget execution. And all these things have an effect on service delivery. So obviously, for this goal of improving or increasing tax compliance to be realized, it is important to bring this missing piece of puzzle into the mix. the commitment towards prudent utilization of revenue. So whereas all these other things that have been mentioned, these administrative reforms of detecting, of sanctioning, of incentivizing tax compliance, what we normally see companies getting rewarded for pay as you earn and so on and so forth, as well as taxes for non-compliance. All these things are important. But to excite this, make this guideline on tax compliance levels work, that the prudent utilization of resources of basically public expenditure is a critical one that again stated explicitly. So those are the comments that we have. We still have a few other issues that we've not mentioned explicitly. For instance, the digital service, the digital economy, or measures to or develop frameworks for measuring for coming up systems to share the digital economy into the tax bracket. That's that we hope to. We will actually combine together for submission of this report tomorrow. But otherwise, so these are the few ones that we wanted to share with you this morning. Thank you. Over to you, Kwame.
All right. Thank you very much, John. So I won't try to summarize everything, but I think what I got is this. So the draft policy is, I think it's 37 pages, right? 33 pages. Let me just confirm that. The 37 pages, it is divided into 5 areas. So the first is the introduction. Chapter 1 is introduction. Chapter 2 is the situational analysis. Then chapter 3 talks about what the policy guidelines, which should be the majority of the paper. Chapter 4 is what implementation framework is proposed, and then the 5th chapter is monitoring and evaluation. So John went through the first, all of them, highlighted them, and then of course talked about the highlights, most of which were concentrated on chapter 2, chapter 3, and 4. Now, so that's the first. In addition to that, obviously John has highlighted a few questions. One of them is that basically our expectation would be that a taxation policy would be respectful of the fact that we have Chapter 12 of the Constitution and the roles of Parliament. I personally saw very little of Parliament to sure how Treasury intends for this to sit. So that's the first point that I have. While John was here, I had a colleague where on Tuesday in a presentation, there's no documenting. So the word Treasury and KRA or the Revenue Service appear 18 times a piece. I don't know if they decided to be, and Parliament only 3 times. So I'm not too sure whether that's necessarily was intended, but it's suggestive of the fact that Treasury, working together with the KRA, are drawing a taxation policy without sufficient acknowledgement of the constitutional roles of Parliament and other arms of government. So that's my view about. That's one thing that I think is clear. The second point is so what we hoped this chapter would achieve, especially the chapter on policy guidelines, would actually to be conceived that Kenya's tax policy is all over, and taxation is all over in terms of the. So among the things that a taxation policy should give us is coherence. What do I mean by coherence? Coherence is just basically a tax system that speaks to each other, because the economy on which we are levying taxes based on the authority of Parliament, not KRA and certainly not the Treasury, is the same. And so if you're talking about the same farm, or if you're talking about the same person, I think the taxation systems should not be something that makes it incredibly onerous, but also one that makes it confusing to treat incomes in different ways. So we say, for instance, Kenya's taxation of excise taxes is one of the most interesting in the regions, because Kenya's excise taxation is not consistent with what the theory of taxation, but what we think an excise tax, and what the name suggests. And I think the Treasury is trying to cover for that, while they go for one thing, they say that excise taxes will be used for activities and products that are harmful, and then adds one other rule at the end and any other objectives that government may pursue. Now, that's too loose in our view for a taxation policy, because then they might decide, for instance, that I'll use an absurd argument that all left-handers, for instance, would be subject to one kind of taxation. So I think that kind of looseness is being allowed so that we can be creative, especially the KRA and the National Treasury, with what they apply the excise taxes to. An excise tax is a mess. It's not achieving those goals, and neither is it achieving the goal of actually raising more revenue for government for the Treasury. So our coherence story, I think it has to be one of the biggest things that a taxation policy should give us. I don't see it here. John mentioned the question of transparency and in revenue forecasting. So John has talked about the fact that a study that the IES carried out, which was just published, I think, in May this year, has shown that government's revenue, the Treasury's revenue forecasting models almost always are too, there's a suggestion that the revenue forecasting models are too bearish, in the sense that they give the impression that more revenue is out there to collect than actually is collected. The effect of that is that it expands the deficit, and that is covered by borrowing, and that has a consequence, not only in the immediate term for the public debt pile, but it has a consequence in subsequent years for how much money is available for the equitable share of revenues that is shared between the national government and the county governments. So basically, the knock-on effect of poor forecasting actually has an effect on the distribution between counties and the ability to provide services. And I think that's one thing that a taxation policy must fix. John, however, says that it's a political economy problem and not necessarily a technical problem. I think, John, because of the wide audience that we have, perhaps the first question should be, what do you mean that it's a political economy problem? So please explain that part about the economy problem. The other point that you talked about is tax buoyancy. It's also a technical term that public finance experts use. John, please explain as well what tax buoyancy is and how Treasury has treated, or rather, this document has treated it, because that's another area that I found interesting. The IE has emphasized that one of the things, and the Treasury itself says that one of the things that is required as a good principle of taxation policy is predictable tax rates and predictable tax bases. In the introductory chapter of this document, the Treasury has mentioned that one goal or one thing that should be pursued for the purposes of predictability and stability is to ensure that tax reforms are at least reviewed only every 5 years, which is a welcome idea. Why 5 years? I do not understand, but still that's welcome. And I think it's something that needs to be discussed, or we should bring to it, because one of the biggest problems with Kenya's taxation is the flippancy, if I may say, in tax rates, in tax models and everything else. So that taxation policy, in our view, is a reflection of just general flippancy. Basically, if we think that, oh, suddenly there's money that's coming in through this, then you raise a tax and you raise a tax, regardless of what the objectives are. So the objectives of taxation are sometimes not met, or they're not consistent, or they are difficult to infer from the way tax rates are changed every now and again. We blame Parliament for that, but often it's also because Parliament is sometimes presented with a fait accompli, given the impression that if we don't raise these taxes, that would happen. The question of sovereignty and the tendency of the Treasury to, in a way, pull the wool over Parliament's eyes by saying that, look, this tax policy has been recommended or has been given to us as a precondition by the IMF. I'm not too sure that's a good thing, partly because the question of sovereignty in taxation, and especially the roles of Parliament in Article 209 to 212 of the Constitution, states very, very clearly that no taxes may be passed. So if Parliament needs to be a little bit more assertive, but I think that the Treasury should not promise the IMF or anybody else, whether they do or not is a different matter, but they should not promise anybody a tax change which they do not have the authority to implement. So that kind of reinforcement and legitimacy of the arms of government is something that I think we could insist upon. The final point for me is, I think a new tax policy would give us an opportunity to say and to dream by asking ourselves, given the structure of Kenya's economy, and John has emphasized the fact that on the labor side, Kenya's economy is very highly informal. So designing a tax system that is respectful of the fact that 80 to 90% of people who work in Kenya work within the informal sector, and sometimes people straddle both formality and informality. How do you design a tax system that is respectful of that reality? But my final comment, which is more or less like this, I disagree with the tenor and the tone of this document. The tone of this document seems to suggest that the fitness of a tax system is if tax collections rise. I disagree, because Parliament has the autonomy, and the Constitution says that Parliament might, or rather allows Parliament discretion to raise or reduce taxes as it sees fit. So the idea that a good tax system is one in which necessarily taxes rise is one that I think we need to get our heads out of. I think it's a very narrative driven largely by the Treasury and the Revenue Collection Service, especially because collection service collects or is allowed a fixed share of what the total tax pie is. You see that the incentive, therefore, for more tax collection to be seen as necessarily useful for the Republic. Remember, as students of economics, a tax levies creates a distortion and inefficiency in the market. So good public policy around taxation should be, one, a tax that is moderate, and two, spread as much as is possible. So the idea that total tax collections in itself is the reflection of the efficiency of a tax system is not consistent with what basic economics theory says. Now, sorry, ladies and gentlemen, for adding my own 7 minutes, but now I'll open up this discussion for questions. I haven't seen anything in the chat box on the question and answer, but you have two options, ladies, as the audience. What you do is you can raise through the reactions box, you can ask your question, and then I'll call upon you to ask questions. On the other alternative is in the chat. To respond to them. Anyone? Smoother. Question?
Hello, just a quick question for myself.
Yes. Munaweza, you have to wait for me to ask you, please. You have to wait for me to allow you to. Yes. So what you should do is use the box to raise your hand. Something.
All right.
Yes. But anyway, since you're here, please go ahead.
My apologies. We are still analog. We are running. So we're saying that I believe that this national tax policy is existing in the framework of other policies that govern issues to do with economic endeavor and also other aspects of the running of government. I just wanted to know whether there's any way in which the national policy on taxation can be positioned among the whole the other policies that are there in government, so that we don't later begin to see either contradictory provisions on policy level, what tax policy is saying one, and probably issues around the planning of the economy and other issues, other policy statements are saying a different thing. Just that conversation between this national policy and other policies that exist, whether it's necessary to have a look at that as part of the recommendations we're going to give to them.
Okay, thanks for that question. Anyone else with a question? Please raise your hand or just let me know in the chat box whether you... Yes, Eric Musau. Go ahead, Eric.
Thank you very much, and yeah, great summary there, and I really appreciate the work done by IEA. I think just just a question on whether this is something to consider. I mean, in terms of like the company, I saw the company taxes. I mean, that has been declining. And I wonder, of course, there was that comment about whether it's economic growth, but you can imagine the pay as you earn has been growing very strongly. The company taxes has been reducing. And I wonder whether that's a factor of formal companies not paying tax, or whether, what is this, whether we're having fewer companies having a bigger pie of business in the economy. And then, of course, there's elements around corruption. But I wonder how that could be maybe captured in the, I don't know, maybe the thoughts around that and how it could be captured in the national tax policy. And then the other element, I think there was a mention about the digital economy, and specifically my sense was around the gig economy, where people are able to, kind of work multiple jobs or something, and how that could be incorporated in terms of thinking about how taxation could work. I know at some point they're trying to figure out if they could have, especially the digital workers, a special mechanism for taxing them, and so forth. And then the other one, especially on the percentage that shows the workers who don't file their returns, especially probably related to the informal sector. But there's also an element around literacy, because especially, for certain category of workers, you almost require an email to be able to file returns. And when you look at it from a literacy perspective, some of the workers, especially those under 20,000 shillings, and in the informal sector, will probably might not need to pay that much tax anyway, because they're below the tax bracket. And then there's a literacy element where maybe they're registered initially by an employer who has obligation to have them registered, but then subsequently they don't just file, probably because they maybe they don't have even access to the email. There's an element of complexity around that. But maybe just to throw it back to you to and see whether that's something that has been considered or could be considered. Thank you.
Okay, thanks, Eric. John has noted those questions. So we have Duncan. Duncan, please go ahead. You could turn on your mic, even your camera as well if you wish to when you ask questions. Duncan, go ahead.
Thank you, everyone. That was a well thought out, a well comprehensive presentation, and it has basically captured everything. I will take this opportunity to laud the team for the great work that they have done. Now, my question is, I don't know if it has been considered already, but could we come out strongly on areas or sectors that affect women in particular? Because I'm here voting for the women economic empowerment. Is it something that let's look at the sectors that affect women and then see whether we can come up with policies that we can recommend in the national tax policy, specifically targeted to areas that are directly impacting on women? Is it something that we can consider?
Right, thanks. Thank you very much, Duncan. We have a question in the chat box from Richard Chelagat, and he says, well, he thanks John for the presentations, and he says, my question is, I think how strategies, I think it means what strategies do you intend to employ to address the revenue forecasting in view of it being political economic question? Yes, which strategies? So John, you can answer that as well. So let's go through this first round of questions, and then I come back again to the audience for the second round. I hope that's okay. Yes, John, please.
Yeah, thanks, Kwame, and thanks to participants for those questions. I will start off with this issue on revenue forecasting, and actually the question that also Kwame had posed. He also actually reinforced the fact that if you get you have errors in the revenues that you forecast, that has implications on the money or the revenues that will be the shareable revenue that will be split between the two levels of government and also on debt. Now, basically, the indicator for this revenue forecasting is first, the expectation that we need to see is that what we've targeted to generate, so the annual revenue target vis-a-vis actual collection, the expectation is that that gap should not be wide. Now, because our gap has been widening only with the exception of the last financial year, 2020-2021, it means there are certain issues around the fact that this gap has been going up. Now, one of them was whether the way we compute or project revenues, our revenue forecast was evidence-based, and what tools or instruments are we using. So, of course, the National Treasury, together with KRA, CBK, and KIPRA, I think within a group called the Macro Working Group, they have a certain model, a macro model, that is used to project those revenues, because what you project to is obviously used as a guide for budgets. Now, in the earlier days, there were issues around just the model itself, the assumptions that are factored, but also that capacity to be able to conduct or estimate revenue projections. But increasingly, the National Treasury, working with IMF and World Bank, have tried to address that aspect of capacity, the capacity question or the technicality of conducting or revenue projections. And I think currently we have a unit called the Tax Policy Unit at the National Treasury, whose work is to undertake this revenue forecast. So to that extent, the issue of capacity or technical know-how is no longer the query. But however, as we have shown, those errors have been going up. So in our analysis, we ask ourselves the question, what has been driving those errors? And our observation is that, as I hear, is that those errors are driven by other things that are outside capacity or technicality. And those issues could be political. Now, what this means is when you have a larger revenue projection or estimated revenues, that tends to reduce the deficit, the quantum of deficit. So it shows that the actual value of deficit is small. And so we think that's one of the reasons or incentives that have driven this unrealistic revenue projection. So obviously the way to address them is just basically, capacity was the main issue, but I think the realism of this is critical, because if we continue in the way of being politically correct or just trying to disguise the actual quantum of deficit to make it look smaller than its actual size, if that trend continues, then it's detrimental to the functionality of our two levels of government. The current situation, what the current situation has done is it has affected or it leads to delays in the disbursement of resources, and counties are affected the most just because of these unrealistic revenues. But then obviously what that has done is that with these big deficits, we have to get into more borrowing. That has led to spike in our debt growth of debt stock, public debt stock, which obviously again comes to affect or reduce the quantum of resources that will be shared again between the national government and the county government. So you can already see all these interconnected implications of having unrealistic revenue projections. So the idea is just to, for proper oversight from public, from civil society, from the media, and from particularly the legislature or parliament, to put pressure and ask questions around this forecast, and basically transparency and around how these revenue forecasts are conducted. When we have all these things in place, then we will have sufficient pushback from the public and from different oversight institutions for government to reduce, or Treasury to reduce, the extent to which it makes it more political than it's supposed to be. So that I think is the one thing that would address this unrealistic revenue forecast. Then now moving on to the other questions. So munaweza, so we haven't conducted an analysis of this policy vis-a-vis the different policies. Of course, the assumption is that in coming up with these policies, it should be just to obviously address aspects of contradiction, that this should be situated within the environment of the other policies. But what you mentioned is that actually this may call for an actual assessment of whether indeed, and then one can look at different policies, whether indeed there are contradictions with other existing policies. So we've not done that assessment, but the assumption is that this should indeed be situated in a way to ensure that there is coherence, as Kwame had noted. Eric, your point about pay as you earn has been rising, company tax, what is causing a drop in corporate taxes? I guess it's more or less related to some of the things that you've mentioned. I've not looked at these, whether we've had some that are leaving, have left, and so on and so forth. So, but I guess it could be related to some of the things that you've mentioned. For the digital economy, the policy is specific on digital economy, not necessarily widening it to the gig economy. So again, we've not done like specific, but we intend actually right after this, once we submit this, we intend to do some thorough work that looks specifically or spotlights this policy to this proposal on the digital economy. And of course, the stuff that you mentioned about literacy, those things, tax education, simplification of tax, those things are critical in terms of just complexity of our tax laws, and going a long way to enhance compliance, especially by some of the people working in the informal sector or the informal sector businesses. So I think there's been a lot of emphasis in that regard in terms of upping the literacy, tax literacy. So what we noted is that there's need maybe for a dedicated program and resources to back that up. Duncan's question on, yes, we were throwing around this issue of gender equity. Having reviewed a couple of other policies, tax policies, the aspect of gender is not mentioned specifically, but we noted a few things. I'm trying to look for that slide. We noted a few things with regard to the fact that the analysis of these different tax whatever should be, the welfare indicators should be captured, because we've noted is that any revenue raising measures will have different effects on the different social groups, and often the vulnerable would be, so I mean basically trying to isolate those biases of the effects of this is critical, because that would help in terms of knowing whether it will enhance gender inequalities, or those measures will go towards reducing the inequalities. But yeah, we've noted that, and I think we will add it and strengthen it when we'll be making our submission tomorrow. I think the final one was tax buoyancy. Kwame had asked that I explain this. So this has been noted. I'm not trying to look for it. It's been noted under revenue performance section of the policy. So it's one of those measures in terms of revenue performance. And buoyancy basically looks at whether tax collection is responding to growth in incomes. So it basically checks that responsiveness of our taxes to income, whereas theoretically there is an expectation that when incomes levels go up, then the growth of tax should also go up. But in our case, what we are seeing, and they've provided a figure there, is that when you compare the growth of ordinary revenue vis-a-vis that of the economy, GDP, which is our indicator of tax, you can see that there is a mismatch. Whereas the economy has been growing, that has not, actually from 2014 all the way to 2020, 2021, the growth in ordinary revenue is actually dwarfed by the growth in the economy. So what we are saying is that this requires some further analysis. It's an important measure of revenue for performance. It was just mentioned, nothing specific was indicated in terms of this, but what we are noting is that it requires, there's need for further analysis. What we see on the different, actually majority of our tax heads, they are not responsive to the growth of the economy. So the tax buoyancy level for this is, I think, less than 1 for a majority of these tax heads. Yeah. Over to you. I hope I've responded to all the queries.
Yes, you have. So we have a second set of questions. I'll read these and then I'll go back to one person who has their hands up. The question is Namasilihe. I hope I've pronounced that right. My question is, what are some of the shortcomings of this national draft? Yes, I think that's one thing that, John, you and colleagues owe to this audience. Basically, what are the shortcomings of the national draft or tax policy draft? And I'll come now to the second question from Pauline. Pauline, please switch on your camera and your microphone, and you can ask your question or make your comment.
Hello. I hope you can hear me.
We can hear you, Pauline. Just go ahead.
Okay. My name is Pauline from CCAK. I'm a member of CCAK and a taxpayer, maybe, or an entrepreneur. From an entrepreneur. I'm an entrepreneur, and I concern. Maybe I can also say that I really don't understand a lot of the issues of tax, but I just have a simple concern as a Kenyan taxpayer and a person who complies. And my concern is that, can it be made friendly? I don't know whether this is the right forum to bring up my concern, but the policies should be simple. I saw something on simplicity. They should be simple enough and friendly to the taxpayer so that it's easy to comply and very friendly also to comply, and the taxpayer is getting incentives such that if it comes like to issues of self-reporting or filing these taxes, there should be no issues of like they are forcing entrepreneurs to buy new ETR machines, the compliance should be easy, especially in this digital era, so that maybe they can do adjustments on their side or on KRA or Treasury, I don't know, whoever, so that for the entrepreneur, it's so easy to comply, just like we are finding it very easy to do anything else online without having to go and buy a new machine like an ETR machine. Or the other issue of simplicity also is maybe sometimes we need our refunds from KRA. It is not as easy to get the refund. We have it, difficult. It's a difficult process to get the refund, yet it's easy for them to get the money from us, or any other tax they need from us. So it should be made more taxpayer friendly, or it should be friendly to the compliant. So those are my concerns. I'm not sure this is the right forum to voice them, but maybe it can be an input for future consideration into these tax policies. Okay, the other concern I had as a taxpayer and as a Kenyan is like now the issues of fuel. We are told there is a government subsidy in fuel, and then after a very short time, there will be an increase from VAT of fuel from 8 to 12. Government is giving us in one hand and getting from us on the other hand. So all these things, they are not very friendly to us as taxpayers or Kenyans. It should be made easy so that we are happy paying this tax, and even more people will join. Thank you.
Thank you very much, Pauline. Yes, the questions you ask are definitely for the right forum. So my colleague John will respond. I haven't seen any other questions, so we'll come for these others. This second round of questions. John, please go ahead and answer.
Okay. Thanks. Yeah, Pauline. So the policy actually, of course, whether in the reading of the entire policy, whether it is written in a citizen-friendly manner or the tone, and that's something up there for the jury. I guess we could even take a poll on that. But what the policy notes is that the issue of simplicity is actually one of its guiding principles, and it specifies that it will ensure that our tax laws are made as simple as possible for easy comprehension and interpretation. Of course, the current picture is that we have a mix. Some laws are more easier or friendlier than others. But what the goal of these policies is to ensure that going forward, these laws are simplified as much as possible. So that's something that going forward we can, whether as an individual or civil society, that's something that we can track and obviously provide our feedback to Treasury. Then the second one is obviously to make the administrative processes simple. So those are the commitments that this policy makes. Then what is his name? Namasilike, China. So your questions about shortcomings. So I guess those are the kind of things that we've tried. I mean, what I guess the media likes to say, the misses. We've made comments around some of the things that are missing or things that should be strengthened in this policy. I guess the aspect of implementation or monitoring and implementation framework would be a useful one, because also we can, on one side, not only it is important, yes, to have a policy that is comprehensive, is coherent, but whether that policy will be implemented or not is another query. So looking at the different implementation, looking at the implementation framework that can affect. Yes, the implementation framework is actually key to the success of realization of the goal that has been set in this policy. But yeah, we've already shared some of those shortcomings. And the idea is when we'll be submitting making our submission tomorrow to Treasury, those are the things that we'll be sharing with them, with the expectation that they will be revised. They will revise the policy to address those shortcomings. Yes, I think that's it, Kwame. I see one query from Richard.
You can answer that as well.
I can go ahead. Okay. So Richard, so what Richard asks is, the main problem is lack of meaningful public participation. In my view, what are my recommendations to resolve this issue in the policy? So obviously for public participation, aspects of awareness have been mentioned, just enhancing awareness. Transparency is key. So whereas awareness is important, but when you don't have reports that are simplified and are provided on a timely fashion, that obviously interferes or is a hindrance to meaningful public participation. So that's basically that combination of awareness, but ensuring that we have transparency in all these things that are being proposed, whether it's reports around the different tax heads, tax expenditure, and so on and so forth. So that transparency aspect is important. The reports have to be comprehensive, shared on a timely fashion. Simplicity and friendliness is important. Yeah, so I would say those are just a few key issues to address or to enhance meaningful public participation.
Okay, John, there's one more from Richard.
There's one more. Yes.
Richard.
Yeah, so it's related to tax justice for Kenyan citizens. We can tax burden is too much and need for the government to review. So the issue of tax burden, we've raised a few issues related to addressing tax burden, of course guided by the principles of equity and fairness, but also the fact that the assessment, like what we've seen in the second chapter, yes, we've had there's some sufficient information on revenue performance, but that has not been performance of revenue and also the different taxes, performance of the different taxes, whether it's VAT, income tax, and so on and so forth. Their performance and assessment of that of those different whatever taxes has not been presented in terms of whether it upholds the principles of equity and fairness. So that has not been made explicit in this policy. Yeah. Yeah, Kwame, that's it. That's
all
it.
Right. Okay, so I don't see any other questions on the chat box, but I have a couple of questions which I'll ask John, and then if no questions come forth, I'll ask for him to answer those two questions and then come up with concluding remarks for the day, since we're already 7 minutes ahead. Beyond our time. So my very strict view, my very strict view is that if we wanted a tax policy, and in the last 5 or 6 years, I think, if you look at every budget statement made in June, just before the new financial year starts, usually the cabinet secretary straddling, I think, about 2 cabinet secretaries now, have said that we'll have a taxation policy. So when does, and it really whetted the appetite for people to see. So the one that I saw, I must say with utmost respect, was underwhelming. So what we have here in this draft is definitely underwhelming. And I think it'll need a little bit more work. I don't know whether that's my own views, but obviously John pointed out a couple of things. So that's one thing. Now, what would I have expected? My view about this tax policy would actually to have been a stronger part on what the principles are. I think that history in chapter 2, which talks about the situational analysis and which is the history of taxes, talking about the fact that Kenya first had taxes in the pre-colonial period, and then the changes, and then the income tax was first done in 1973, enacted in 1974. In my view, that would form a very good book for the history of Kenya's taxation, but I don't think, well, maybe it informs how taxation system has evolved over time, but I don't think it's an essential part for telling us what the national tax policy is. So even if it's been included, that's fine. I expected the greater part to be actually the identifying the challenges. I think the challenges themselves are also very, very, it's woolly in the sense that it's not been, it's not exhaustive. The list of challenges is not exhaustive, but the challenges would be essential. I think the second point would be to respect the constitutional principles, because the Constitution under Article 201 tells us what are the principles that should govern Kenya's public finance architecture should be. And one of those, of course, intergenerational equity, proportionality in taxes, in the tax burden and stuff like that. So that's one of the things that I'd have expected us to then draw the challenges, and the tax policy should be responding to those challenges and what the Constitution demands, and then obviously the institutional structure. But I'm a little concerned that this taxation policy is being drawn to justify the existing tax structure, which, to be honest, has had a very heavy hand from both the administration of taxes, or tax collection, which is the revenue service, and on the other hand, the Treasury itself. And very little space is left for Parliament. And I have a problem with that. Partly because, as the law states, 209 to 212 of Article 209 to Article 212 of the Constitution, actually tax policy in Kenya is what Parliament allows to come in law. Tax policy is what government allows to come in law. So the fact that this tax policy is being drawn as if Parliament is just on the tail end of the tax structure, the taxation policy formation, is something that I think requires significant revision. So that's the first point. The second point is the lack of justification. So, for instance, the Treasury says in this draft that we will have 5 tax brackets. Now, what's special about 5? And then they say that the only justification that they provide for that is that so that we have progressivity. Look, people, you can have 3, you can have 10, and you can still have progressivity. Why 5 is essential, or 5 is where we relay it for, is something that I've never understood. You can actually have tax bands. Basically, brackets mean where the limits are drawn. So say between 10,000 to this amount and then this amount, and each of them having significant rates. And the question that we need to bear in mind is progressivity is not necessarily about just the number of tax brackets that you have. Progressivity can also be what the changes are in the tax rate for each tax bracket. So I'm not too sure that mixing the tax rates on the one side and the number of brackets on the other is an important thing. But I think that is a political decision. And that's why Parliament comes in. And that's what comes in again with Richard's question about the tax justice. So how we form or how we interpret what justice is about the tax brackets and the rate of taxation is a political question. It's usually not something that pure economics or administration tells you. But you understand the incentives that the National Treasury and the tax administration, which is the Kenya Revenue Authority, would bear is for those brackets to favor more collections necessary. So what we think of as tax justice, it's upon us then as those who are to actually bring that back in into this conversation. And the third point for me is I think we need to really place Parliament, in my view, parliamentary committees, but also Parliament as a whole, meaning both the Senate and the National Assembly, in the center of drawing the national tax policy. Why? Because the authority for taxation law, and it cannot have any taxation without law, is through the National Assembly and the Senate together. So this tax policy, in my view, should be something that in many other places could have been drawn through a discussion between Treasury on one side, citizens, and the representatives of those citizens in Parliament. So it should be something that is a compact between people, representing more or less like this, what our interpretation of a social contract would be. And the final one is just generally a question of transparency. A question of transparency, and especially transparency throughout the taxation process. The taxation throughout the taxation process. So, John, please respond to those. I haven't seen any other questions. I had some feedback from a camera, but it looks like it's interference. So please answer those questions, and then we can close. Or your responses, and then.
Yeah, so Kwame, for some of the issues that you've raised, I think, for instance, Parliament not clearly being at the center of this is something that we can actually add. On implementation framework. Sorry, I think I had dropped. Chapter 4 on implementation framework. And yes, there's a mention of Parliament there, legislature, because they mentioned the roles and responsibility in implementation of this, of the policy, of course, but in the drawing of this, we don't see much mention of Parliament. Yeah, so that's something that we will note as well, as well as on the aspect of the constitutional principles. So the one on the burden is not proportionality in tax burden is not mentioned. I think the one that's mentioned is just on the predictability of tax base and tax rates. And as I make my final remarks, is there are a couple of things that have been mentioned together with what you've shared, Kwame, that we will use to just enrich the draft memorandum that we have. Issues of gender equity, tax justice. Yes, we saw that aspect of progressivity, yes, and I agree with you. Progressivity is not necessarily about the number of tax bracket. We hadn't. We noted this, but we have not captured this in our in the memo, and that's something that we could add as well. Yeah, so basically some of the things that have been mentioned will go a long way to strengthening the memorandum that we've already drafted. So we are very grateful for those proposals. We hope that there will be an opportunity from Treasury to make or present some of the, in case some of the proposals or things are not clear. I hope that they will invite different groups to make a presentation in terms of just clarifying the comments and the views that we have on this. Otherwise, thanks a lot, everyone, for the comments, for the questions, and we hope to have a similar discussion that specifically talking about taxation in the digital economy. So please look out to our social media for this. Thank you. Yeah, Kwame, over to you.
All right. Thanks a lot, John. I hope I'm clear to everybody else because there's a lot of crackling from your side.
Muted. So you're muted.
No. So, ladies and gentlemen, thank you very much for this conversation. Thanks for being here. We'll make sure that this conversation is available online. In addition to that, John's presentation will be available, and the brief that we sent to Parliament, to the Treasury, will be made available on our website by tomorrow afternoon. That stated, we are grateful for your being here. Please know that the IEA is a membership, an association. So we invite individual members and professional members. So if you'd like to do that, please send an email to us and somebody will follow up with you. That stated, have a good afternoon and thanks for sitting in with us. We'll let you know when our 20th webinar will be. Thank you very much and good day.